Crypto markets stalled despite trade deals with the EU and Japan. On-chain demand remains strong despite whales seen selling. And vol continues to grind lower. But some put skew is coming back in Bitcoin. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran Larker from Options Insight. I've got man Dave from FRNT. And today's special guest is Dan Blackmore from Glassnode. Welcome.
Thank you very much for having me. Really happy to be here.
Yeah, good to have you on, Dan. It's been a while in the making.
Got lots to ask you about Glassnode and the on-chain stuff. But before that, why don't you tell us a little bit about your background, how you got into crypto?
Yeah, sure. A dangerous question, so I'd love to give my life story, but I'll keep it quick. So I originally started my career in Tokyo, actually, in Mitsubishi Research Institute, which is essentially a management consultancy focused on energy, the department I was in. So that got me really interested into the commodity markets generally, so that when I went back to university, I thought, right, I want to move into the markets. So I went to Bloomberg, essentially, was a cross-asset specialist on their Japanese desk there for a while, which then helped me spin out into investment banking later on, where I was a rates trader and rates salesperson at Nomura for most of my career. That was great. I loved the team, really enjoyed it. But over time, I started getting more and more interested in crypto generally. For me, it was less from a Bitcoin maxi, digital gold sort of thesis. It was very much from the where you can program smart contracts, essentially. Right. So day to day, I was having issues with bonds not settling, and thinking there must be a way to automate this, because you guys, I'm sure, very well aware, in traditional finance, so much of it is built off legacy infrastructure that it really needs upgrading. So essentially, I thought, well, this stuff looks like it's probably the way to go. And so then I moved on from there to Coinbase Institutional, which was great as well. Loved the team until eventually I moved to Korea, and then started working for Glassnode, essentially. Now I'm back in London working alongside Glassnode and their sister firm Swissblock as an advisor, and here we are.
Cool. And so when did Glassnode start?
They've been around for a while, since around 2017. Okay. There wasn't an exact start date, because originally they came about because Swissblock, which is a investment group company focused mainly on proprietary trading, actually started developing tooling, which was the early version of Glassnode. That was helping them trade, make money, manage risk. At some point, friends, investors said, can we start using this? It looks like a good platform to use. That's when they span it out into a completely separate entity, its own product, and Glassnode grew and became the brand it is now. That's how they came.
So for those who don't know, I can't imagine anyone watching this doesn't know, but what is Glassnode? What's the kind of mission? What is it you guys are providing?
What's the value of on-chain metrics and stuff?
Yeah, so I mean, it's very much an OG of the on-chain space. I can talk a bit more about on-chain at the moment. Like in later years, it's very much focusing on trying to be broader. So it's not just on-chain. It's very much about putting on-chain data into context alongside off-chain typical market data. So we're very much, first and foremost, a data company that also does analytics and research. When it comes to on-chain data, it's very much a complicated space if you're not used to it, right? There's a lot of jargon there, so I think it's helpful to just dumb it down a bit and try and understand what that actually means, essentially. So the simplest way to start thinking about on-chain data is to start with off-chain, right? Off-chain just means, typical traditional market data. So data you get from exchanges, for example.
Like price data, basically.
Price data, volume, open interest, etc. And there's lots of people making a lot of money just using this data alone. That's fine. Most people typically just look at this sort of data, hedge funds, institutional traders, etc. Now, the issue with that is they're leaving alpha on the table, essentially. There's other insights they could be getting through this whole other data set. So the way I think to classify on-chain data generally is in a few different ways, a few different buckets. You can think of DeFi for a start, so things happening on DEXs, on lending platforms. That's one world of the on-chain market. And then you've very much got the ledger, the on-chain data itself built within a blockchain, essentially. So the easiest way to categorize this is to think of 3 different layers, essentially. So you have the first layer, which is just network data. So what's actually happening in
like
the
transaction
network.
volume type stuff.
Exactly. Transactions, how many wallets are on the network.
Is that hash rates? and
Hash
things?
rates,
Yeah.
the fees that might be generated by different blockchains.
And that gives us a barometer of like the health of a blockchain, basically.
Exactly. It's very intuitive, right? It's quite similar to social networks, for example. If you have a bunch of people using the network, there's network effects, it starts growing.
Usage numbers, those sort of
Exactly.
things. Okay.
I think that makes sense to a lot of people engaging in the space.
And you can see the trends in that going up or down or whatever and derive like some sort of outlook, I guess. Right?
Exactly, yeah. That only takes you so far, because the next layer that you really need to think about is capital flows. How are assets actually moving around that network?
What in terms of what type of players are buying or selling?
Well, that's the third layer, essentially.
Okay.
So the middle layer is literally just how is money moving, and then the third layer will be who are the holders.
Okay.
Are they a large entity like an exchange, a custodian? Could it be a different type of behavioral cohort? So is it a large whale versus a small
And the
shrimp?
reason you have that granularity is because on chain you get to see, like in a normal TradFi market, you'll see volume, but you won't be able to say who's doing what, basically, necessarily.
Yeah, typically you don't know, right? You just see, volume goes up, price goes up or down.
Yeah, whereas here
don't
you
know
can
who's
actually see
transacting.
which wallet is doing what. Basically.
Exactly. And the thing is, the trouble is with this data, a lot of it's just noise to your average person looking at it. So if you just see pure blockchain data, it doesn't really make sense
No,
to anyone.
it has to be interpreted.
Exactly. And so that's where some of the skill comes in to actually be able to translate this data into set entities and cohorts.
Okay.
You need labels for that. You need to know who a whale is versus a smaller player, for example.
So yeah, what are some of the labels then? Because everyone talks about whales. And
Yeah, well, it's
I don't know why they've given them all these animal names.
Yeah, no, I know, right? So the easiest thing to think of for me is definitely institutions versus retail. If you think in terms of, say, long-term holders versus short-term holders, that might be, say, real money versus fast money, if you're thinking in traditional finance terms. So they're just broad categories to think about different behavioral dynamics, essentially.
Yeah.
So these...
Because those actors, they trade in different ways, right? Like hodlers just sit on it for years and years and years. Short term will have a different propensity to certain sort of return they're targeting, and their holding periods will be much shorter.
Right, yeah,
Exactly, right.
yeah.
And you'll get a different type of... You can see when you look at these different players, you can see their actual cost basis, where they've actually transacted on the network.
And that's
in
that's a
aggregate.
metric people care about, right? That they keep an eye on.
Yeah, the reason it's relevant is because if you know the average cost basis of the network across different cohorts, you're going to have an insight into whether someone is sitting on a lot of unrealized profit or loss. You'll also be able to start seeing if they're actually taking profits into, say, strength in a rally.
Is
for
there like a
example.
consistent level of unrealized gain or loss that tends to trigger like that psychology and that behavior? So is it like the short-term holder unrealized loss is never allowed to go above a certain amount because you start seeing people cutting and stopping their losses? Like, are there quite consistent sort of levels in these metrics?
I mean, it depends with crypto, right? Things can get so volatile, but in short, yes, you just have to normalize it based on a standard Z score. You can look at moving averages, for example, but
Yeah.
typically Z scores, if things move, say, depending on the metric, which I needn't delve into.
Sure. So
but
it's a level of how extreme it is compared to
if you,
normal.
if
Right.
you start hitting, say, 3 sigma difference, versus the average, then that's probably going to be telling you something.
Okay.
So it really does depend.
And interesting, again, that level of granularity. Like one of the things we get asked about a lot. We've been talking about a lot. Obviously, there's huge demand and buying pressure from not just the ETFs now, but the Bitcoin and crypto treasuries. But yeah, we had the move higher in Bitcoin, and then it kind of stalled, and then we've chopped around, call it like this 117, 120 range, give or take, for a bit, which we assume is just, there's still a lot of supply, all of these big levels now, there's just a lot of supply, a bit from long-term holders, whales. Are you seeing that? Is the data showing us that on the chain?
Yeah, definitely. Like every cycle, as we start to rally into strength, you'll always see long-term holders start taking chips off the table. There's always somebody on the other side of that trade willing to buy up at that price. I think that's natural. I think if we were all sat on a few hundred million, for example, it'd be wise perhaps to take some chips off the table.
Is
right?
there signal value in that? Like, does that tend to happen 3 months, 6 months before a top or anything like that? Like,
Yeah, I think it's more in terms of the short-term holders. So the people that have recently...
there's more signal in the short term.
Yeah, typically, because they're the people that are coming in that are either smaller retail money that's much more volatile perhaps, or less informed on how the network works. They might be faster money, which are trading in a different way versus just hodling, for example. So I would say typically the things you want to be thinking of, if we make it really basic, is really just looking at short-term holders. How much profit are they currently sitting on? You know, is that starting to get out of what you'd expect as a typical range? And then do they start taking profits on that, for example? Are they doing that quickly? Is the rate of change very steep? You know, or is it very soft and just typical?
So what are we seeing right now in those metrics?
So metrics are looking very comfortable right now. Everything is pretty much middle of the range, nothing looking too steep or out there when it comes to where we're at right now. I don't like to give price levels typically, but generally, if you're looking at a lot of typical on-chain metrics, things might start to look a bit overheated, say, from 140 onwards, between 140 to 160, things are maybe starting to get overheated from a purely on-chain lens.
What is overheated? What are the signals that tell you overheated?
Well, it just depends. It could be that people are starting to really start to sell into strength aggressively, for example, or they're very close to their cost basis, and maybe you can start seeing, if we're going the other way, people are starting to sell at a loss. So it really depends on where we are in the market, what's happening at any given time.
Because I used to look at on-chain Glassnode, actually. I used to use back in when I first got into crypto in sort of 2020, 21. And I found it super interesting, but being a shorter term sort of trader, well, to be fair, I'm an investor as well, right? So I have different time horizons, but for my long-term asset allocation, I found it quite helpful. I didn't really find it that helpful for short-term trading signals, right? Has there been an evolution in the suite of products to like provide a little bit more for the people like me who want some short-term signals?
Yeah, I mean, firstly, you're right. Like, first and foremost, especially if you're looking at Bitcoin, it's very good for understanding large cycles when we start topping out in markets, where there are inflection points in the market. If you're a very high frequency, fast intraday trader, you're going to find a lot more noise. And that's typical across lots of different metrics you might be looking at. So what we've tried to do at Glassnode is focus beyond just Bitcoin. So we've made sure that we've expanded the horizon of assets we're covering, and within other assets you can start to see more signal. It's trying to find the interplay between what's going on in Bitcoin currently and how it's playing with other assets across the networks.
So is the behavior similar, like what you see in ETH, for example, as to what you see in Bitcoin?
Yeah, I mean, it really depends, right? Because the second you start moving out of Bitcoin, you're entering a completely different world, essentially. You're looking at smart contracts, you're looking at different apps built on top of chains. If you look at ETH itself, for example, you just have the base layer ETH, and then on top of that, you have a bunch of ERC20s that could have all sorts of different dynamics. So it's hard to just summarize and say, you know, one's particularly similar to another. It really depends on where the flows of capital are at any given point in time.
Speaking of ETH, obviously ETH is a hot topic again, finally. We've spoken about it a few times.
Well, you're calling for new highs, but yeah.
Yeah, I'm calling for new highs in the next month. Again, we kind of, and I look at things from, again, being a macro guy, from a very kind of high level. For me, obviously, the narrative just looks good right now around ETH. What with the passing of the Genius Act and stablecoins, what that means for on-chain activity, and of the ETF flows have picked up, and the inflows have been massive actually. And then obviously the ETH Treasuries is another big narrative arc that's helping. What are you seeing in the on-chain data? That either supports or not. It feels like you're seeing NFT activity and stuff pick up. Interested to know what you're seeing on in terms of ETH specifically, and what your thoughts are around that.
Yeah, I think if you're thinking of ETH specifically, it's always important to put it in the broader context of the market as a whole. So it's hard to know what's going on with ETH unless you've got a good idea with what's going on in Bitcoin. So I would always start there when looking at the market as a whole. How are we looking in Bitcoin? Both from an off-chain lens and an on-chain lens. Right now, we're looking very structurally healthy in Bitcoin. on-chain fundamentals are looking solid. Momentum's come off a bit. We're probably consolidating in a range, but structurally, we look good. We look fine. There's no turn in the market. I don't think anyone's worried we're going to tank tomorrow, for example. That's important because it's the oxygen for ETH. So we're certainly seeing a rotation out of Bitcoin into ETH. I think there's no surprises there. The question then really is, where do we rotate from then on? What are you looking at? Very much, obviously, you want to start looking at large caps before the rotation into mid caps, small caps. It's trying to find the indicators that give you an insight into that. And there's no one single on-chain indicator that can help you there. It's very much a blend of, say, momentum in spot. How quickly is certain assets changing versus others? Is there an impulse there? Are they starting to break out? Combining that with leverage in the system, etc. And then overlaying the on-chain lens on top to see, yes, where are the funds flowing? Is it across long-term holders versus the short-term holders, etc.? So it's very much about looking at the market with a lot of different lenses and bringing in on-chain to give you one piece of a bigger picture.
Does on-chain allow you to identify different regions and how they're acting, for example?
Geographic regions, right?
Yeah. Because I hear a lot of the buying happens in Asian hours these days.
Yeah, for sure, right? It seems to be, Asia, at least very recently, the past week, Asia seems to be particularly bullish, moves across into Europe for a bit of selling and then US selling off a bit more.
Yeah.
Not sure of the exact dynamics around that. So yeah, it depends on the platform you're using. The space has so many different types of analytics platforms that it depends on what you're using. There are a few players out there which very much focus on money laundering, KYC type products, and they focus very much on regions because obviously there are players out there that need to know if you're accepting funds from North Korea, Russia, etc.
Right.
That's something that we don't tend to focus on, mainly because we're focused on active traders, investors, researchers and content creators that care more about the dynamics of the market versus, say, the region that activity might be happening in.
Yeah, just fascinating to me, like having worked for years on an FX desk, like there was so much around like trying to understand flows and structure of flows. And a lot of it was done through like surveys and getting clients to fill out surveys and different desks and a lot of it was finger in the air type stuff. I think like we really take like for granted the level of granularity and detail. And so like for traders, and again, keep saying to like sort of friends and ex-colleagues in the traditional space, it's like there's so much like alpha and data available in this space, like that and I don't know where they're at now. It's been quite a few years since I've been on a traditional trading floor, but I'm pretty sure it's still again very kind of high level, very sort of guesswork as well now, because it's really difficult to really divulge too much in terms of the types of clients. So it's become even more abstract in terms of what you can give. And now like we're able to see like wows versus like these smaller guys, regional stuff. I think it's like fascinating.
Well, you'd have to go to, for example, if we're talking bonds, you'd go to a bond dealer before who's actually sat in the middle of the flow, right? They can't tell you this client bought, this asset, etc. But they can say we had real money come in.
Yeah.
The Japanese lifers doing some sort of cross-currency trade to do X, Y, Z. You got that from the guys actually managing.
Yeah, because they've
flow.
got the vantage point. They can see the flow.
Exactly, exactly right. Now you can start looking under the hood and seeing this stuff yourself. The issue is, again, a lot of people aren't quite used to thinking this way yet because it doesn't exist in TradFi. So it really is about having these frameworks for thinking about it and saying, okay, how do we split up this market? How do we think about it? And yeah, network fundamentals on the one side, capital flows on the other, and then the types of holders on the third side is a good way to think about it.
The question I have, like, for example, it's a bit similar to a question that I asked, I think, Darius from QCP about the options market, right? So in TradFi, the S&P, for example, the options market is huge and it clearly has a big impact on what the S&P does day to day, right? The hedging flows that come from those options are having a real impact on the futures market and the spot market in the S&P, right? And I asked him, is the options market in crypto big enough to really have impact, right? And how much, actual delta hedging is going on relative to the massive flows that go on in crypto in the Delta One space. Okay, so I have a similar sort of question for you in that is the on-chain activity how big a share of that activity is going to tell us where markets are headed? Because, for example, I know that I don't interact with the chain very much, right? I trade crypto, I get long, I get short, I trade it, and there's probably tons of hedge funds and people like me who are trading it who don't really interact with the chain because they've got their margin, it's in their accounts, they're trading derivatives around it, and they're expressing delta views long and short. And that's a large part of the volume and activity within the crypto space. So how much of it really is on-chain? And therefore, how important is the on-chain data in kind of guiding us, would you say?
Yeah, I mean, well, firstly, especially recently, there's been a lot of on-chain activity going on as you've had these large cliffs of Bitcoin, for example.
These whales of, do we think they're actually selling or just reallocating to somewhere else?
Yeah, I mean, there's rumors flying around about that. Yeah, I don't know. I saw in the PR release, apparently it was some sort of tax planning strategy. But,
right, so it wasn't a big liquidation or anything?
No, not as far as I'm aware. But
or worse, people. And I've seen like obviously the rumor mill starts doing the rounds that they know something. Like they know that something's changed, and like I know quantum computing is going to blow up Bitcoin.
I mean, either way, the market absorbs it very easily. Across a weekend, it's phenomenal. But yeah, recently, so on-chain volumes are very much up. And to your point, yes, if you're an institution, you might not have to worry about self-custody being on-chain. You just sign up for the exchange and you do all your trading on exchange. That doesn't mean you don't need to be, say, aware of metrics that are out there or data that's out there, because at the end of the day, everything has to move across it on-chain at some point. If it's funds moving from custody to exchange, that will be baked into the blockchain itself. If it's moving between chains, it's going to show up at some point. So although there might be a lot of different flows or volume trading on an exchange, at some point it's going to move, and that's going to be baked into the exchange, and you'll see it. The other thing is, that's for now, right? I think a lot of people out there, myself included, really think more and more of the market's going to move on chain long term. So if we look at RWAs, for example, at some point,
real world
assets, be it tokenized bonds, funds, stocks, etc., you'll start seeing that on chain. And I don't think people will care or know. Will people care if they're technically trading on a decentralized exchange versus a centralized exchange? The idea, I think, for the whole industry is to make it so no one really cares or knows. You're just trading on an exchange. Who cares if it's on or off exchange? So I think long term, it's going to become even more relevant because everything will be.
And we'll be able to see on-chain information about stocks that are tokenized.
Oh yeah, imagine some of the crazy stocks out there, be it the Nvidias or the Teslas or the meme stocks, etc. Actually being able to look under the hood and start seeing what type of players are playing with this stock right now. Are they selling into strength? Are they just cutting their losses? What's going on under the hood? So I think it's only going to help long term. And it becomes very relevant to say governments or international bodies that need to actually be able to track what's going on with flows globally, right? So if you look at, the fiasco of Musk going in with Doge and trying to, save the government money, etc. One point I think they did have was they saw dollars being sent to addresses that didn't really have an explanation for it. I think that was just incompetence, really. But this stuff is easy to miss. When it's all on chain, everything's transparent. You can track this. An algo will start picking this stuff up. And so I think there's going to be a vested interest in governments, international bodies, to actually start, fostering this sort of on-chain ecosystem long term when they start seeing the benefits.
So you guys are well positioned for that.
Well, I'd think so, long term, yeah, for sure.
Yeah, no, it's interesting. Like, I think having the view that it's just another lens to look at the market at, just like the options market, right? What I do is another lens to look at the market, see the certain nuance, see the option flows and how they maybe are giving some clues as to where. None of these things are a crystal ball, right, that just tell us what the market's going to do, but they just give us another ingredient and another way of kind of trying to figure out the puzzle. I
think there's a lot of similarities with the options market. From my understanding, most people in finance, traders or investors tend to have a fundamental understanding of most instruments in what's going on, the dynamics moving markets. But I find that when you start moving into options and the vol world, it becomes nuanced very quickly, quite technical very quickly, and you get specialists that are very much capable of managing that sort of risk. And I would like to say, the rest of us are kind of looking at guys that can manage that risk and are trying to figure out what's going on. Maybe it's just me, I don't know. And I think just because you don't necessarily understand some of the nuances there doesn't mean it's not valuable and moving the market in many ways. The on-chain world's very similar. There's a lot of nuance to how things are moving, a lot of different ways of thinking about the market. And there aren't yet people that truly have the intuition for understanding this market. So a big part of what I'm trying to do and the team's trying to do is start educating everyone to understand that there's this other lens, as you said, like options, you have a lens, on-chain, you have a lens. It's just knowing how to use it, make sense of it.
And how are you educating people? Is there like newsletters? Is there videos that you guys do regularly?
Yeah, for years now we've been doing the Week on Chain, which is a very popular newsletter, which is very much focused on-chain flows, but putting it into the context of broader off-chain market flows generally.
Okay.
So that's something we've been doing for a while. Market Pulse is another. That's more off-chain focused. It's very much a quick bite-size systematic sort of piece that you can read in 2 minutes, every week, which will give you an update on the market. So that's very much our focus.
What I like, I mean, you just sort of hit the nail on the head. Like I've always said, like our job as traders or investors is like we're just trying to figure out enough pieces of the puzzle to get a picture to make some, probabilistic decisions, that are in our favor. There's so many moving parts, and you're never going to have all the pieces to see it completely. So the more pieces of information you have, but again, it's how you use those and how you put them together. And that's why, I mean, I get accused of being like a permaball.
Why?
But I've been that way for the last couple of years because, again, from the lens that I look through and the framework that I have, we're in a structurally sort of bullish environment for both for crypto and for broad risk. I say I joke when I turn bearish, and there will be a period when we're in a structural bear market. Everyone's going to probably shit themselves, but like that will come.
That will have market impact. The day that you turn bearish, the market is going to dump.
But the point is, like when you have these kind of a core sort of structural sort of view of the world, and which we try and share on here, and I love what Glassnode are doing. It allows you to kind of just dull out some of the noise, and so like for instance, right now, we're just chopping around in this range. Bitcoin, it's not really gone anywhere for a few weeks. What does it mean? And then so to hear someone go, well, look, structurally, everything we're seeing on chain just looks fine. Like there's nothing going on, as opposed to like I've seen something change in the structure of flows or the pattern of flows or network activity, whatever it might be, that says actually that we could be in for a sort of rockier period or whatever it might be. But this is what always frustrates me on Twitter and stuff. There's so much noise. It's like, look, everything looks fine, guys. We're trading like a 60, 70, 80 vol asset. It's going to chop around a lot.
30 vol now.
30 vol, yeah.
Unbelievable.
Yeah.
Cutting off.
ETH is around 60.
Yeah.
But like, so we're looking at all these things, and then people kind of hit back. Oh, I thought you said it was going up. We just sold off 5%. It's like, come on, guys. But again, if you look at the underlying sort of structure of these markets, everything still looks great, and you've just kind of supported that.
Is there any risk on this quarterly refunding announcement that we need to be aware of? Because I think that's the only macro story to really mention.
I mean, we've got the Fed obviously tomorrow as well.
But we know they're not going to do anything.
But they're not going to do anything. I think they'll probably tee up the September cut, to be honest.
I'd just be interested to know if is there a press conference?
Yeah.
Be interested to know what Powell says when everyone starts asking about where he's going to get fired.
I mean, he's pretty good, right, at sticking to a script, and he kind of I think he manages that stuff pretty well, actually, given the amount of sort of pressure that Trump puts him on. I mean, that was like a Laurel and Hardy sketch you see the other day with the two of them.
Well, with their hats on.
When he hands him the you spent like 3 billion or whatever it is, and he's like,
why do you think he's so reluctant to cut, other than the fear of sticky inflation? I mean, a few years back, he was keeping rates low for ages, right? So now he's kind of changed his tune.
Yeah, but I think for that reason. But I mean, the problem the Fed have is they're so backward looking and everything. But if you're sat where Powell is right now, inflation's still above target, still sticky. They've got the whole tariff thing going in the background that they don't know how that's going to sort of feed through short term. The economy is actually, I mean, Trump keeps saying himself, the economy is actually looking pretty good, pretty resilient. There are signs of, and I think this is where people calling for cuts. There are under the hood, there's signs of softness, particularly in the labour market.
Housing index as well.
Yeah. So there are signs of softness that says, and given that you have the transmission of policies, normally like the lag of policies, normally 12 to 18 months. So if we're seeing these signs of softness, given that rates are still like pretty high, nominal rates.
That's right. If you need to counter the job weakness you'll see in a year, you need to cut now.
Yeah, just cut now.
Yeah.
I just think, I mean, I don't know how much I buy into how politically influenced. I do think an element of that goes on. But I just think right now he's looking at it saying, look, we've got plenty of firepower to cut if things do turn quickly lower. But again, I think there's a naivety in that on Powell's part in terms of, again, not thinking about the lags. And this is why I think we go to zero rates much quicker than people think, because if things do turn, and there's nothing that I'm seeing that says it's going to materially turn in terms of the high frequency data, but if it does turn, it turns sharply as you typically do when you go into recession. They'll cut and nothing happens because it won't for 12 months. And then they'll cut again and nothing will happen. So then they just keep going and going, and that's when they overcut and then they stay too low for too long. But I think, look, they made a huge mistake and a huge error keeping rates too low for too long. And I just think he's sort of petrified. And right now, there's not enough in the data for him to sort of cut. So he's just being really cautious with it. I think it's as simple as that.
But what about this issuance of bills versus...
So the biggest data point this week is definitely going to be the quarterly refunding announcement, which is tomorrow,
on Wednesday.
Wednesday.
When this will be released.
Yeah, it comes at 8:30 EST. We'll see the make of that. Now we've just had what the funding requirement is. It's 1.6 trillion over the next 2 quarters.
What's a trillion between friends?
That just someone pointed out on Twitter earlier. The bailout in the financial crisis was 800 billion. So technically, we're now bailing out the economy every quarter. So that's just 1.6 over 2 quarters.
Okay.
And most of that is in the first quarter. About 1 trillion and change is in the first quarter.
Yeah, and this exactly explains why Bitcoin's just going to the moon.
Yeah.
Right?
Yeah.
Because, when it used to be a big deal to bail out the whole financial industry for 800 billion, and now we do it every quarter.
Yeah.
So what is the value of money? Money's turning into toilet paper.
But then the problem for Bitcoin comes, I mean, that's the long-term story. It's going to keep Bitcoin forever going higher. The problem in short term is then around the liquidity impacts. So when they're issuing this amount of debt, it's going to soak cash out the market, right? So this is why tomorrow is really important, how they raise that. Now, if they issue a lot more longer-term debt, that's basically harder to fund, and that's going to draw sort of cash out of other areas. The talk is that they're going to again carry on this Yellen type of what we call almost like Treasury QE, where they'll issue more bills at the front end, which is easier to fund because it takes money out of the
money market funds.
Money market funds, the RRP. So all these are easier sort of ways to sort of fund it, which will tend to be quite good for liquidity. But
because those are already effectively parked in cash-like instruments, right?
Yes.
So it's an easy switch to buy those bills.
Yeah.
If you're incentivized to by the yield that you're getting.
Yeah.
Whereas to liquidate other assets to buy longer-term paper is a harder decision. Right?
And if they do that, and we'll see what happens tomorrow, it will feel like a form of yield curve control, because they're gonna issue less coupons, i.e. 10-year bonds, 30-year bonds, and they're going to do them at the front end. The other interesting thing, and I've seen a few people talk about, well, actually, this could be really problematic, because then what that's going to do, by issuing a chunk at the front end, that puts pressure on yields to go higher in the front end, which causes all fun.
Are we talking sub 1 year?
Sub 1 year,
Sub 1 year,
yeah.
Okay.
And Treasury bills, well, then that potentially causes funding issues. And if you remember in 2019, we had the repo blow up, where basically repo rates exploded higher, which then immediately impacts risk taking. The problem with that then is if you get that pressure on the front end yields, then it becomes inconsistent with where the Fed are trying to set rates. So then the Fed essentially have to come in and supply liquidity into the front end to keep front end rates that are consistent with where they're trying to set Fed funds rates. So the interesting thing is that it might be a way of Trump and Bessent saying, look, if you're not going to cut rates, then we're essentially going to make you supply liquidity into the front end, and we got to keep rates across the curve lower by making you supply liquidity to buy at the front end. So I think either way, all of this leads to some form of financial repression. I guess the worry for some of the macro bears out there will be we might go through this rocky period of front end rates spiking before the Fed come in and supply liquidity. But they seem to be ahead of that because they've lived that experience. And again, I kind of feel Bitcoin will just sniff that out and go, there's just more liquidity coming. But either way, 1.8 trillion over the next couple of quarters, it's gonna be printed in some form or another.
Yeah, it's interesting.
Bitcoin's a hedge.
Yeah, I mean, there's a few people talking about seasonality, which seems to matter these days quite a lot. If you look back at the last few years, certainly within stocks, seasonality has worked quite well. Tends to be a bit of a period to be long vol between, say, now, start of August into October. You tend to get a seasonal period where vol does pop a little bit. Markets kind of go flat to slightly lower. And then we get a year-end rally that kicks off in like October normally, something like that, right? So
yeah,
it wouldn't be that surprising to me if there was some kind of stress created by this, what you're describing, that leads to a little bit of de-risking that then gets bought back into when they see them pump liquidity back in to kind of clean up the mess that maybe Trump and Bessent create, right? I don't know.
Yeah. So I think this is a really interesting week. It'll be a question of how on top of that the Fed are. I've got some comfort from the fact that they started to taper QT, and I think that was within mind that they would come up to this period, like once the debt ceiling lifted, and how they're going to fund all of that. So I think the Fed are kind of ahead of it and thinking about it. I think, and maybe that's going to be the more interesting thing from the Fed tomorrow as well. Just any comments around that and the refinancing, how they do that. So it's an important week. It'll be one for us to talk about, like when we next get together. But again, generally, Dan, you've said it yourself. Online metrics all look good. On-chain metrics, all look good. We're still in this world of liquidity is pumping everywhere. We've got sort of fiscal coming out of Europe, Japan, China, US. It
always comes back to the liquidity, right? Basically.
Yeah, and so. Yeah, it's difficult for me right now to see where, and equities keep hitting record highs as a result.
Yeah, Bitcoin.
Bitcoin again, I think, and same with even ETH at these levels. ETH's had a move. It feels like it's digesting more supply, but it still feels like it needs one more kind of sort of ramp higher.
I think for me, the biggest takeaway on this ETH move is shown me that the depth of liquidity on the offer just isn't there for like $5 billion of like inflows that want to happen in short order, right?
Yeah.
So as these treasuries come up and decide, okay, we've bought a load of Bitcoin, $100 billion worth of Bitcoin treasuries out there, you get a small percentage of that wanting to come into ETH now. There's just no offer, right? Like 1% of circulating supply gets bought and it roofs it by 30+% in a couple of weeks, right? So it just shows you if that's how little liquidity there is for the demand that's potentially out there, then I agree with you. It's got a lot more upside.
Yeah, and which is why I think we could see like new record highs in ETH by.
I don't know whether it happens in a month because we might get just a wobble in broader risk assets in that period. But yeah, by year end, if we get a year end rally in equities like we normally do, then God knows where ETH's going. I mean, I don't know if I buy into the 15,000 target that Tom Lee's thrown out. But yeah, I mean, we could definitely see like 6,000 to 8,000 if it really wants to go.
How many of these Bitcoin treasury, ETH treasury companies do we even need, right? Like at some point, again, going back to my points around network effects earlier, when you've got the big three, big five maybe, beyond that, it's
people are jumping on the bandwagon.
Exactly, right? So unless there's a difference in the location these companies are in, and certain investors can only invest in, say, Japan, for example, versus US.
I think some of that is it's that
like Metaplanet, for example,
regulatory arbitrage or whatever, right?
Yeah, I do find it. like it does concern me. Like the Bitcoin treasuries, like just make a lot more sense to me. But because fundamentally, I see Bitcoin as a very different asset.
Yeah.
But ETH is productive if you think in terms of staking, powering DeFi, etc. So there's a yield there that kind of can make sense to these.
Yeah, I can get it. I just think the more you start then going out the risk curve, you kind of it feels always very much more like a tech play, which may or may not pay off. I know from personal experience from past cycles, I come out of every cycle thinking I should have just bought Bitcoin. I wonder if some of these treasuries going, we could have just done a Bitcoin treasury. Like we were, we thought we were building a treasury in the next big thing. And it turns out that Bitcoin was the next big thing. And I have more sympathy for the ETH trade in terms of, again, I just think...
it's what everyone's building on, isn't it?
Yeah. Like in terms of if I was going to, what I think is more likely to survive, it feels like it's the one. But yeah, the more we start going to a risk curve, it's just, I feel people are sort of making tech plays and putting them in their treasuries, which is, I think there's a lot more risk around that. But
I think it definitely does start to smell like, there's some fragility there, and it might need some of these players who are late to the party, if they are late to the party, are going to need to be washed out, right? But the structural stuff that like you're seeing and just like the way regulations have just opened up for the space, I think it's hard to not want to buy dips. You're kind of praying for a dip that you get to then get into again, right?
Yeah.
So it feels like to me.
Yeah.
All right, cool. Pleasure to have you on the show. Thanks for joining us.
Yeah, it was really interesting, Dan.
Thank you.
And we will catch you guys back here, not next week, because I'm off on holiday. So we're going to take a break next week, but we'll catch you back the week after. Cheers.